Hello, everyone. I'm Lauren Moon. I'm here with Jonathan Ting. Jonathan just got 4 cavities filled, so he gets extra kudos for being here today and helping me talk about what we talked about in investment committee. So,
Uh,
Jonathan, are you able to move your mouth enough?
oh, definitely, definitely. Let me just put it out there first that I brush and I floss every day. Okay, it's called genetics. Genetics. Okay.
Okay, that's what my kids tell me too. So, one of the things we talked about in the investment committee was the Fed's announcement that they are going to be tapering on a more accelerated timeline than we previously thought, than the market previously thought. So, what does that mean? What does that mean to you personally, professionally? And then
Yeah,
we can talk about what we're doing in our strategies about that.
yeah, of course. Uh, Actually, I think the cavity reference is a great example of what's going on in the market. And let me try to tie these two together, okay? And I hope it makes sense. So when my teeth started getting a little bit sensitive, right, and might use Sensodyne, right, anti-sensitive, thing. I might put some numbing agent on it, right, to try to get it past. And that's sort of what's been going on in the markets for the past year. Right? When we talk about what's been driving the markets, well, it's not fundamentals. When the economy shut down with COVID, it was monetary policy and monetary stimulus supporting this economy, and that was just like the Novocaine and the Sensodyne was supporting my ability to continue to chew and eat. Um, but eventually, that Novocaine has to go away. I can't brush with Sensodyne forever. So hopefully, at some point, my teeth, my enamel have to rebuild, and I have to be able to. My teeth have to be able to fend for themselves at some point. And I think that's what we're coming up against, and what the Fed has been implying with their recent meetings, which is, by 2023, there may be 2 rate hikes. The economy has been recovering better than expected. So it really implies that we're on the other side of monetary stimulus, if we think of it as a hill. So the support that we get from the Fed will only be less and less and taper off from here on out. So to support this economy, at least support prices going forward, we're really going to have to see the enamel in the economy come back stronger and fundamental growth and earnings take over and unemployment return to those high levels, to keep the economy on stable ground. So not only is the U.S. deleveraging, but I think that's going on with a lot of the major economies. We saw China start their deleveraging about 2 months prior. So we're going through a sort of global pullback in stimulus. So as we make that transition from stimulus receding to fundamentals picking up, that transition we make some chop, right? And how we've reflected that view in our portfolios. In MLS, I think Don added a little bit of PSQ, which is short the Nasdaq, and in Mags has added a little bit of BXX, which is a sort of a bet on volatility rising. Pretty much 2 different instruments, but they reflect similar views on the market and the idea that as we enter this time where people are going to be watching the Fed closely and what they say and try to figure out what that implies for the future of the market. There may be some chop, and it'll be chop, but I don't think we're too worried about it. We pick our companies individually. We hold the companies we like for certain reasons that are unrelated to external factors. Um, so we're ready for anything, cavities or not.
I'm not sure how much your enamel regrows versus having to have it drilled and filled, but
Well, that's
we'll
the
leave,
risk, and that's
we'll
why
leave
we've
that
added,
part of the analogy.
right? Yeah.
um, so uh, we looked at kind of the allocations of the strategies, how they're positioned. Don's talked about this in prior videos, but we've changed our positioning slightly this year to focus more on these industrials, in oil, in companies with hard assets, and that those have all been doing well as we emerge from COVID, and we expect they'll continue to do well as we get over this hill. So Um, in terms of how we're managing portfolios and our outlook, I would say that our positioning won't likely change significantly other than the kind of volatility dampeners that we're putting on and off. Do you agree with that? Do you think you'll be looking to make any other changes one way or the other?
When it comes to mags, not so much. I'm sticking with companies that have real tangible growth and you know uh, good prospects going forward that are trading at great prices. So we like these companies on a fundamental level, regardless of what's going on around them, right? And we may trade in and out of them on the margins, when we see prices get a little too overbought or add to positions when they get a little too oversold. But I don't think on a fundamental basis we're going to be making any major shifts to the portfolio or hopping in and out of sectors. As I said, during this time, there's going to be a lot of trading, depending on that are based off of the
Announcements
words the
coming from
Fed
the
uses.
Fed and headlines coming out and that sort of thing.
Yeah, I think the important thing to note is the overarching trend, which is we are on the other side of that hill. So we can see how things are going to look long term and how prices might be affected. How that trades in the short term in terms of sector rotation or factor rotations, that's not going to be something we're going to try to play on in mags, nor do I think it's going to be something we're going to try to play on in the other strategies either.
Great. All right. Thank you, Jonathan. Hope everybody
Thank
enjoyed
you,
listening
Lauren.
in today. As always, feel free to reach out with any questions or comments or topics you want us to talk about the next time we uh, do one of these videos. Great. Have a great day,
Bye.
everybody. Happy summer. Bye.